This week, we're flipping the spotlight away from tech and shining it on a surprisingly overlooked part of the market: financials. While everyone's busy chasing the AI capex boom, there's a quieter story unfolding. A story that could unlock major upside potential for banks, insurers, and investment firms. In this episode, we'll unpack why the financial sector might just be getting started, what risks investors need to keep in mind, and whether these tailwinds are a short-term cycle or something more long-lasting. Of course, if you'd like to read the full article with way more detail, you'll find the link to it in the description. Now, let's get into it. Beneath all the AI hype and data center dollars, someone has to move the money. Financials, like banks, investment firms, and insurers, are the plumbing behind the digital gold rush. Right now, three big trends are giving the sector a boost: a steepening yield curve, a rebound in IPO activity, and booming capex that needs financing. Let's start with interest rates. The Fed has already pulled the trigger on 2 rate cuts this year, bringing the federal funds rate target to 3.75 to 4%. And while markets are still digesting the latest Fed meeting this week, there's a strong chance we get another cut by December. So what does that mean for banks? Well, in simple terms, a steeper yield curve means they can borrow short and lend long at better margins. That's good news for their profitability. And investors are already starting to take notice. FactSet data shows that earnings expectations for financials are being revised upward. That matters because it's often the spark for a re-rating in share prices. We've seen this already play out in sectors like tech and industrials. And financials, well, they could be next in line. The next tailwind is IPO activity. After a quiet stretch, the IPO market is back in business. Q3 this year saw a 19% jump year over year in global deal volume and an 89% spike in proceeds. According to Renaissance Capital, and as we covered a few weeks ago, we haven't seen this kind of energy in the IPO market for years. So why does this matter for financials? Well, because every IPO needs underwriters, analysts, and marketers, which is the whole investment banking engine. And those engines live within the financial sector. More IPOs means more fees, more revenue, and more upside for the firms involved. And lastly, the third tailwind is the capex boom. Citigroup is forecasting that AI infrastructure spending will hit $490 billion by the end of next year and over $2.8 trillion by 2029. That's a tidal wave of spending, and it needs financing, insurance, and investment guidance. Financial firms touch every part of this process, from loans and bonds to equity raises. And this isn't limited to just big tech. CapEx is expected to grow across the board, with Morgan Stanley forecasting an average 8% increase in 2025 across all industries. In other words, financials are set to ride the wave, not just from tech, but from the broader economy in general. But like any sector, financials have their vulnerabilities, so let's talk about some of the risks. Interest rate risk remains a concern. If the Fed were to reverse course and raise rates again, borrowing costs would rise and margins could shrink. Then there's regulatory risk. Post-2008 reforms like the Dodd-Frank Act and Basel III have made compliance more costly, especially for large institutions. And let's not forget credit risk. If the economy slows or dips into a recession, defaults could rise. As JP Morgan's Jamie Dimon likes to say, recessions come every 7 to 10 years. And when they do, lenders feel the heat, which we'll touch on next week. These are real risks, and they're worth factoring into any investment decision. So here's the big question. Are these financial tailwinds temporary or structural? While no one has a crystal ball, as nice as that would be, there are signs that some of these drivers could stick around for a while. For one, M&A activity is picking up again. Deal values in tech, media, and telco have been rising since mid-2023. Private credit is booming, with Morgan Stanley estimating the market could grow from $3 trillion to $5 trillion by 2029. And AI-enabled efficiencies are already saving financial institutions some serious cash. JP Morgan, for example, has cut its payment validation rejections by 15 to 20% and reduced incidents of fraud by using large language models. That all suggests that the financial story might have longer legs than some people think. So what's the insight here? Financials are the quiet force behind the boom. With tech grabbing the headlines, financials are the ones fueling the engine. And right now, the engine is running pretty hot. From monetary policy tailwinds to IPO demand and infrastructure financing, the financial sector is positioned to benefit from multiple angles. If you want to find the strongest names in this sector, check out our high-quality financial stock screener, which is linked to in the article. And don't forget, diversification matters. Financials might be gaining steam, but no one single sector should dominate your portfolio. Use our portfolio tool to check your sector exposure and make sure it aligns with your own goals and risk tolerance. And that's where we'll wrap up this week's Market Insights. As always, if you'd like to read more on today's topic, you can find the full article, which is linked to in the description. We'll be back next week with more market insights. But until then, invest well.